Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Calming the markets, Britain's Chancellor tries to reassure investors after her budget triggers a sell-off in UK bonds. We will bring you our conversation with Rachel Reeves. Apple sparks fresh concerns from investors as China revenues disappoint, but Amazon and Intel both surge after beating estimates. Plus, the Fed's key inflation measure proves sticky. Later today, the other side of the dual mandate gets updated with the US jobs report.
Well, ahead of that, Anna, take a quick look at some of the markets in the European session. You are seeing futures relatively flat right now. A lot of that could change, though, as we get closer to the open. Remember, a lot of volatility in earnings going into the remainder of this week. So we are going to see perhaps some of that get pared back ahead of the weekend. That risk-taking cable, of course, 128 handle that we're seeing, not as volatile as what we're seeing in the gilt market. And then Brent crude, of course, with one eye on the Middle East, trading at a 74 handle, higher by about 1.7%. The countdown to the opening trade starts right now.
That budget wipes the slate clean so that we never have to do a budget like this again. We are cleaning up the mess left by the previous government, but we are meeting our fiscal rules 2 years early. We've set the spending path for public services for the course of this Parliament. We will do a zero-based review to make sure we're getting value for money for that spending. We have had to make tax increases, but that is to get our public finances on a sustainable footing.
Good morning, everybody. Let's start there, shall we? Let's start with the UK and the rising gilt yields that we've seen over, well, certainly since the budget, arguably into it as well. But was that a Treasury move? Kriti, lots to talk about here. Just in yesterday's session, then, we saw those moves in gilts paired a little, but up 12 basis points at the 2-year, up 9 basis points at the 10-year. Over 2 days, the 10-year up by 25 basis points. If you go back to the beginning of October, we're up more like 50. But there was the Treasury move in there as well. Difficult to separate, perhaps, some of what's happening in the US Treasury markets and the election impulse from what's happening in the UK. But if we're just taking out one rate cut from the Bank of England, or maybe even, more than one rate cut, maybe that makes sense, but the pound is not necessarily giving you that signal. So there does seem to be more to it than that. And that's what we were trying to get from our guests just yesterday. Is this just a rational repricing of rate cuts out of the Bank of England, or is this something more?
I think that currency picture is so interesting. That's that kind of diversion that you're seeing between the bond market and the currency market, because if you do look at the currency market, that's where people are seeing that stability. And from an international investor flow, even though you do have organizations like the OBR saying whatever this fiscal budget yields is not a long-term solution, it is still seen as a positive and an ultimately expansionary policy for England and for the currency picture as well.
So we'll wait to see whether Rachel Reeves has said enough. We'll bring in more of that interview, of course, later in the programme, later in this hour. You just wonder how the risk stacks up for the UK now. We'll open gilt markets in around 57 minutes' time, and we'll get a sense there of whether they have been calmed or not. US data and the US election could, of course, move centre stage.
Yes, volatility, and in that volatility, where do you hide out? Is the pound or is the gilt market perhaps one of those havens at a time when maybe tech may not be, especially on the heels of some of the earnings we got this week in particular, in the last 24 hours? Apple, Amazon, and Intel. There's a lot to digest here, but I'm going to start with the highlight for me, which is Amazon, and I think that's really the crucial story. A 38% operating margin on AWS, their cloud unit. Just for comparison, by the way, Google's cloud unit has a 17% operating margin. That's how much Amazon, AWS specifically, is able to monetize their cloud. It's not just about getting that business. It's about actually being able to turn it into some real money.
And our colleagues telling a story of a CEO who's managed to take other costs out of the business, and that frees him up to do the CapEx in the places that matter, and maybe plays into that margin story that we're talking about. And CapEx is the story, isn't it? Because $75 billion worth in 2024 and even more in 2025. So increasingly setting the market up for that heavy spend. And then we got a positive move on Intel, a rebuilding story coming through there, and Apple, a little bit of disappointment, a little bit around the China story.
Yeah, kind of a reversal of the norm, if you will. The Apple thing is interesting because Steve Wozniak, one of the original founders of Apple, or co-founders of Apple, actually said that Apple is becoming a one-product company. For someone who is a avid Apple kind of buyer, that feels a little bit far-fetched, but it's a key point at a time when Apple is trying to compete with the likes of Huawei in China. It's also crucial for Intel because that turnaround story has been one in the works for years. It's finally bearing a little bit of fruit.
Shall we pivot to what's going on in the US macro picture, Kriti, because there's a lot to talk about there. We had the PCE data out yesterday reminding us that we can still talk about inflation. It is still part of the narrative over in the United States. But today we move on to the jobs report. The range is wide for what we get here. We could see something as low as a contraction of 10,000 jobs. We could see 180,000 created. That's the range of estimates. The mean, I think, is around 110,000, 100,000 jobs created. Of course, that's way down on what we've seen in recent months because of the hurricanes and the strikes. And it'll be really difficult to get a clean number this time.
Yeah, the whisper number coming at about 136,000, as you mentioned. I think it's crucial here, though, is it's coming 24 hours after that sticky PCE number that you talked about. What is the bond market more receptive to? Is it the inflation mandate or is it still the employment mandate? And it feels like we kind of hop between the two. And I'm wondering if net-net, we're kind of right back to where we were, that this is all dependent from a market's perspective on what happens on November 5th.
Absolutely. So that takes us right back to the election, doesn't it? And on that election, so many global assets depend because, of course, as we started the conversation talking about UK gilts and the pound, you know, they're masters of their own destiny to a point. And then quickly next week, we'll start to talk about the impact that, you know, strong dollar has had up to this point and the rise in Treasury yields that we've seen, whether we get any unwind of either of those. We have a range of great guests set up this morning to talk about some of these themes with us and to bring those conversations to you. Shortly, we'll be speaking to Pooja Kumra, Senior European and UK Rate Strategist at TD Bank. Great person to talk about gilts. What exactly is moving the gilt market? Is it those shifting rate cut expectations? Is it something more? We'll get into that. We will also have at the opening trade, so at 8 UK time, and we'll also get gilt markets opening then. We will speak, though, with Morgan Del Don, Head of Investment Strategy at Global X ETFs. We'll get a take on the earnings story so far. Tommaso Valletti joins us, former Chief Competition Economist at the European Commission, to talk about the competitiveness agenda in Europe and how that will withstand a Trump presidency, if that is what comes to pass. What would Harris mean? We'll talk about all of those things. And Sarah Simon, Head of European Consumer Staples Research at Morgan Stanley, will join us. We will certainly see the risks that some consumer companies face when they put such emphasis on China exposure. We've seen that in the States and in Europe. We'll pick up on that theme.
Absolutely. And as we talked about that, it might actually just circle back to the States, though. In the next 24 hours, plenty of data. As we talked about that jobs report coming out at 12:30 p.m. UK time. Remember, we are still at a 4-hour difference with the East Coast in the United States. It's 8:30 a.m. local on Wall Street. 2 p.m. UK time as well. We get that ISM manufacturing data. It's not the biggest chunk of the U.S. economy, but it still matters in terms of where that weakness actually is. As long as it remains in manufacturing, that economic resilience story will stick. But then earnings comes into it as well. Remember, in the UK and Europe, we're talking a lot about these record profits, these windfall taxes as well. Exxon and Chevron are going to be dealing with the same thing. Curious to hear what those comments are looking like into the context of the Middle East. Plenty else to digest in terms of what we need to know this morning. Let's go around the world. Shares of Nomura closing in the red, even after reporting better than expected profits. The move lower comes as scandals mount at the company and threaten to derail the turnaround plan underway at Japan's biggest brokerage. Nomura's CEO and other top managers agreed yesterday to take a pay cut after the firm admitted an employee manipulated the bond market. The company is under further pressure after reports that a former Nomura worker was arrested on suspicion of robbery and attempted murder of elderly clients. Now, Brent is surging today after Axios reported that Tehran is preparing a major retaliatory strike on Israel within just days. The report adding that Israeli intelligence expects the attack to be carried out through pro-Iranian militias in Iraq using drones and ballistic missiles. And Spain is deploying 1,700 soldiers to assist in relief efforts and rescue victims trapped by storms that have killed more than 150 people in the country's east. The extreme rainfall triggered one of the country's worst natural disasters in living memory. The National Weather Agency says one town saw as much rain in 8 hours as it normally gets in a year. Anna, this is, of course, a crucial and developing situation in Valencia. The pictures, the images, truly horrific in terms of what we're seeing in terms of the damage. This has broad-ranging effects, not just on the lives of the people affected by the storm as well. We're showing live pictures of some of the damage there in Valencia at the moment, but also has an effect on things like the government response. They are now, of course, deploying those troops and those relief efforts. But in terms of how much this affects the budget and, in turn, the bond market.
Yes, and how does this come back to influence the politics is a crucial question, isn't it, Kriti? Because it hasn't taken long for people to say, well, why wasn't there more warning? If there'd been more warning, could more have been done? Could people have taken action to avoid the loss of life? And as you said, more than 150 people killed. Bloomberg Green has some really interesting analysis talking to experts, meteorologists on the subject. You know, we saw a year's rainfall in 24 hours, which would be difficult for any built environment to cope with. But what do we need to learn about the way these built environments are constructed, where they are constructed, how much space they leave for water to leave, and how much they leave people in the way of that water? All of that really crucial.
And this is something that's going to have, of course, an insurance impact. We talked to some of the Spanish banks as well. It will take them a couple of months to see how this affects potentially their bottom line as well. I think this is also crucial at a time when European infrastructure investment is so top of mind for so many governments. We'll see, of course, how that all shakes out at a time when, again, there isn't a ton of fiscal headroom, not just in the UK we talk about it, but, of course, across Europe and certainly in Spain. But, of course, our hearts with those affected.
Yeah, absolutely. We'll certainly pick up on that story later in the programme. Coming up, we will also return to some of the corporate news flow. Boeing reaches a provisional agreement with unions to end a lengthy labour dispute that's crippling commercial aeroplane manufacturing. We'll have the details, plus we'll bring you more from our interview with the UK Chancellor, Rachel Reeves. She was speaking just as bond markets were closing up yesterday. So what kind of reaction to her conversation with Lizzie Burden do we get this morning? She's seeking to calm markets. Has she said enough? Up next, we will preview the final jobs report before the Fed decision next week. Abigail Watt will be joining us, a US economist at UBS Investment Bank. If you want to get involved in any of these conversations, we love to hear from you. IB plus BBTV Go is the function to use on your Bloomberg terminal. This is... Welcome back. This is the opening trade. We still have around 45 minutes until the opening trade for Europe this Friday morning, and things look a little mixed, a little calmer than perhaps over the last couple of days. We'll see if that is indeed what comes to pass. We need to talk about what's going on in the US markets, though, in terms of the data picture. As the US presidential race enters its final few days, we get crucial data about the strength of the labour market due later today. Let's bring in Bloomberg's Valerie Teitel, who's got details. And Valerie, it's going to be pretty difficult to get a clean reading, a clean sense of what's going on in the jobs market this time around.
Yeah, exactly, Anna. And it's very complicated because we're leading right into that U.S. election and the Fed meeting next week. But the unemployment rate is expected to stay steady at 4.1%. The headline payroll numbers is expected to add 100,000 jobs to the U.S. economy. But about that headline number, Anna, because of the disruption of the hurricane and the Boeing strike, the dispersion of estimates is extremely wide. The widest that we've seen in over a year ranges from negative 10K to 180K. And if we do get this 100K payroll number, it would be one of the lowest prints we've had in nearly 4 years. Now, we have had some recent Fed speak before the blackout period, kind of dismissing and downplaying the data we get today. We heard from Christopher Waller himself. He said that he won't be easy to interpret this jobs number, and he also went on to say that the effects of the hurricane and the strike already knock 100,000 jobs off today's print. So that's a little bit of how the Fed is viewing this muddied picture that we could get today with the jobs print. Here's the long-term trend of payroll growth. Now, we have seen an easing labor market over the course of the last few years. But again, Anna, the risk is we get a second hot print in a row, and it tempts us to doubt the Fed cuts to come.
Valerie, thank you very much. Bloomberg's Valerie Teitel setting up our next conversation very nicely. Let's bring in Abigail Watt, US economist at UBS Investment Bank. Abigail, nice to speak to you. So let's start with something Valerie said there, which was about how the Fed is going to look at these numbers. So Christopher Waller giving us those clues, saying 100,000 is what he would have expected the hurricanes and the strikes to take off the job creation number. Is that a sort of useful rule of thumb for when this number drops later?
Yeah, so I think when we're looking at this data, you know, we're clearly expecting this to be a noisy report. We had in the summer, in July, we had Hurricane Beryl impacting the data there, and we, noted the noise, in the data then. I think if we're thinking about the storm impacts, we've baked in around a 10K impact this time around, which is smaller than we had for Beryl, because I think when we think about the weather impacts and the implications of that, the timing of the storm really matters. So for the establishment survey, the survey's done the week ending the 12th of the month, and the hurricane this time around came a little bit too early to have as big an impact. So we've baked in a slightly smaller estimation in terms of hurricane impacts. But when we think about the strikes, the BLS published their strike report last Friday, and in that they had penciled in a potential impact of 41.4K. So we do have a sense of where that kind of estimate is going to sit. And you can look for kind of hints in the data. It should be fairly clear when we look at the kind of industry breakdown in terms of where the job gains are. That should give us some steer in terms of, one, the potential impact from hurricanes, because some sectors are more likely to be impacted than others by the weather impacts, but also where we know where those strikes are, right? So we can see kind of where those two effects are in the data.
OK, and sticking with the sort of details of the data that we're going to get later on, the unemployment rate perhaps takes on even more relevance then, because some have suggested that that's not going to be as affected because it's collected in a different survey, it's not going to be as affected by the storms and by the strike activity.
Yeah, so when we look at the household survey, as you say, the unemployment rate does come from a different survey in the US. There is one series that we can look to potentially see the weather impact within that data. So not at work due to bad weather is the series that we'll be looking out for in terms of weather impacts. But as you say, our expectations for the unemployment rate are that we think it will hold steady at 4.1%. We do think there's potential kind of upside risks to that. One of the things we've been looking at is potentially some seasonal issues in the data there. So if we look at kind of seasonal adjustments, that would potentially suggest some upside risk in the unemployment rate today. But as you say, those people that are kind of not at work due to bad weather, they would still be classed as employed in that household survey. So, we could potentially see kind of, a cleaner read there.
How clean of a read are you getting in terms of disposable income for a lot of Americans? It feels like, yes, we're talking about kind of hiring and firing trends around the payrolls report, but I'm curious how much savings, pent-up savings, that's kind of been fueling this almost zombification of the U.S. economy, some would argue, and how much of that is long-lasting as opposed to how much of those savings are kind of drying up. Do you have insight into that?
Yeah, so this is one of the things that we've been talking about a lot this year. Our overall view in the U.S. economy has been that we think it's slowing. We had the GDP data earlier this week, and it was another healthy print, and we saw another healthy kind of consumption gain through Q3. But if we look at the kind of 3 quarters to Q3, the pace of growth has certainly slowed to around 2.5% in the 3 quarters year-to-date annualized. If we look at that same number last year, that was 3.2%. So we have seen that slowing, and we think a part of that is this kind of, this kind of step down in excess savings that we've seen in the economy. And I think the other thing that when we think about excess savings that are remaining, we have to think about where they're sitting within the economy. And if we look at the income distribution, when we look at kind of liquid assets by income quartile, we can see that the lower end of the income spectrum have kind of spent down those savings, whereas the upper income groups are sitting on kind of relatively healthy piles. Yeah. And if we think about kind of marginal propensities to consume, it's more likely that the lower end of the income spectrum would be kind of spending down those savings. So that's one thing that we've been talking about quite a lot this year, with clients is this kind of potential for kind of slow down and potentially kind of running out of steam a little bit at the lower end of the income spectrum in particular.
You're definitely in top form this morning talking about marginal propensities. Talk to us a little bit about, though, that liquidity picture that you were talking about. I mean, this is from a consumer perspective, but then you have the other idea of kind of corporate money sloshing around the system. And it feels like the Fed is almost enabled or encouraged to continue with their QT thinking as well in terms of pulling out some of that excess liquidity from the system. How sustainable is that? If we see, say, a pause in Fed pricing, what does the QT picture look like in terms of addressing that liquidity?
Yeah, I mean, I think from our perspective, policy, the Fed's overall policy is still restrictive, right? And I think even if you see our kind of expectations from them, where we see them kind of getting down to around a 2.75 to 3% range on the Fed funds by the end of next year, even with that, that's still neutral in our view, right? We're not necessarily, I think this is one of the things that people can see kind of rate cuts and kind of overemphasize the ability for that to kind of stimulate the economy. What they're doing is removing excess restrictiveness, right? They're not necessarily kind of turning outright stimulatory. So I think that's one thing to kind of bear in mind in terms of the potential implications of Fed easing to kind of come.
Abigail, just to tie together the two events taking place next week, of course, we have the Fed decision, we have the election. I mean, there's going to be so much uncertainty around the election, and the timing of these two things is sort of incredible, really, coming so closely. I mean, what thinking do you think the Fed will be giving to the election as it makes its decision? I think you expect a cut, right? Is that correct? Yes, you expect a cut. So it's not as if they sit on their hands waiting for clarity, or indeed waiting for things to play out over a longer time horizon. They just carry on regardless. Is that the thinking at the Fed?
Yeah, so I don't think there's been a press conference this year where Chair Powell hasn't been asked about the implications of the election for this kind of decision that's coming next week. I think the thing for the FOMC is going to be the policy implications and the implications of kind of potentially trade policy or kind of fiscal policy decisions that happen after the election in the new kind of administration. That's what they'll be thinking about, but they won't be thinking about that until they're announced, right? They'll be baking that into expectations, they'll be baking that into their forecasts when they know what that looks like, and I think they won't know what that looks like next Tuesday or Wednesday even. Yeah. So I think if we're thinking about the November decision, we are expecting them to kind of deliver a 25 basis point cut. I think, in the press conference, Chair Powell will obviously potentially get a question around the implications from the US election outcome, if it's known by Thursday. And, I think it will come up in the press conference, but I think really the focus is going to be what is the path ahead? What does that look like? And kind of what is the pace going to be? Because they're stepping down from that 50 basis points in September to a 25 basis point cut.
Yes, and it's interesting, Kriti, the way these two things come together in the same week, because when they did 50 earlier on this year, there was an argument from some that maybe it was because they didn't know if they'd want to be cutting rates at the same time as this big electoral event with lots of uncertainty and lots of implications is taking place. But that doesn't seem to be the narrative in the markets right now.
It doesn't, but I'm wondering if that's also a function of trying to decide what the lag time is. So if they did cut rates and when they did the 50 in September, did they act, or are they actually looking for that to show up in the economy, say, middle of next year? What does that lag look like in your perspective?
Yeah, I mean, it's a totally fair point, because it's the same on the way up, right? The kind of restrictiveness of policy acts with a lag, and then the kind of easing of policy also acts with a lag. Our expectation is that we actually might continue to see the economy slow into next year. But I think one of the parts of that story is also kind of broader policy uncertainty, not just kind of what's happening with the Fed and monetary policy, but also fiscal policy. If we remember, we've got the expiration of the Tax Cuts and Jobs Act. There's a number of provisions there on the individual income side, that could potentially create a great deal of kind of policy uncertainty through next year. And so that's one area, that we're really thinking about as we go into next year and the growth implications. But yeah, there is certainly a lag between the kind of cuts that will be delivered and when those might be felt in the real economy.
Yeah, fascinating. And on multiple fronts. Abigail Watt, U.S. economist over at UBS Investment Bank, joining us around the table this morning. And it's a really interesting point. She talked about taxes as well. I didn't even get a chance to ask her about the deficit, but there are so many policy implications outside of trade and outside of tariffs that have to do with the domestic story that are perhaps a little bit more receptive, or a little bit have a clear read-through into, say, the bond market.
Yes, and it does seem, as if the bond market is discerning a difference between a possible Trump and a possible Harris presidency when it comes to inflation. That's certainly a lot of what the Trump trade seems to add up to when you talk to those in the bond markets. But I'm not sure on the fiscal side whether markets have really grasped what difference this is going to make. Yeah. Some voices tell us, look, everyone's just spending big regardless. That's the fiscal vibe we're getting at the moment.
Yeah, and you've made a really crucial point that in a Harris kind of victory, if you do see a deficit that is not increased as much as is expected in Trump, does that actually mean yields come down, even though that's fundamentally a riser for yields? A lot to digest. We're going to talk about that throughout the rest of the show. But coming up, we're going to bring our focus right back here to Europe. Spain ramping up relief efforts after deadly storms in the eastern Valencia region. We're going to have the latest next, talk about the implications, talk about the relief efforts. Trust me, this is a story you don't want to miss. Stick with us. This is Bloomberg.
Welcome to the opening trade. Friday morning, everybody. 30 minutes until the start of equity trading here in Europe and a start for the gilt market as well. Let's have a quick look at where we are on the futures picture for European stocks. Things look a lot calmer. We do have some tech earnings, actually, to digest, but that doesn't seem to be causing too much trouble for European stocks right now. We're expecting it to be pretty range-bound, it would seem. We don't have a host of European companies reporting this morning. US futures, flat to positive, up a tenth on E-minis. Nasdaq futures up 0.2%. Let's go to the bond markets. Of course, European bond markets just opening up now, continental European ones for sure. Gilt markets opening in half an hour. This is the picture that we see on the yield story over in France, in Germany and in Italy. And you can see we see a bit of selling, but extremely small moves in yields, given a period of extreme volatility in gilts and to some degree some movement elsewhere as well. We will continue to watch these European bond markets and bring you the gilt story as it opens, and we will return to the gilt narrative shortly. Kriti, but we've got some other data.
We do. This one time is coming out of Switzerland here and already seeing a major market move. We'll start with the data. Swiss October kind of consumer prices rising 0.6% on a year-over-year basis. The estimate was 0.8%. So you are seeing weakness in terms of that inflation story. It's really building the case for another cut from the Swiss National Bank. But here's what's important here. It's the currency move. You're seeing weakness again across the board against the dollar, the euro, and the pound. What's crucial here is that some of the inflation decline actually came from hotels, package holidays, energy prices as well. And no, Swiss inflation hasn't actually risen going all the way back to April, Anna. So this idea that it's having this deceleration in the data, despite a strengthening in the Swiss franc, that's the concern. That's the kind of job at hand for the SNB.
And the SNB, the Swiss National Bank, has been out front, hasn't it, in its rate cutting. And even when it wasn't foreseen by most economists, they got out there with a rate cut because the inflation story is so different. The central bank facing that strong franc, they've hinted at more easing. We will watch and digest these numbers. Let's get back to the gilt story, though, because that's also our focus as we bring this week to a close, to the UK, where markets have been digesting the Labour government's first budget. Just before the markets closed yesterday, and in fact, as they were closing up, we spoke to the UK Chancellor, Rachel Reeves. She was talking to our colleague Lizzie Burden, and she was seeking to calm investors.
We've seen such a ferocious gilt sell-off. It's spreading now to stocks and sterling. Are you worried that we're heading for a Liz Truss situation?
The number one commitment of this government is economic and fiscal stability, which is why we put in place yesterday in the budget robust fiscal rules that we will meet 2 years early. There's a significant fiscal consolidation during the course of this Parliament that takes debt as a share of our economy from 4.5%, which is what we inherited, to 2.1% of GDP. And we've set out a framework for the second phase of the spending review based on the envelope that we set out yesterday. That will require difficult decisions, but they're ones that this government are prepared to make because we know the importance of economic and fiscal stability.
But, Chancellor, your margin for error for meeting your main fiscal rules near historic lows. If there's even a minor hit to growth, you'd have to hike taxes more to hit your fiscal rule. That's not very stable for the bond vigilantes, is it?
We have more headroom than the previous government left us, and that is important to guard against those sorts of shocks. But we, in the budget yesterday, were open and honest about the scale of the challenge left to us by the previous government, but we have now put our public finances on a stable and a solid trajectory, including through difficult decisions on increasing taxes. We did increase taxes yesterday by £40 billion. That was necessary, alongside with the changes we've made on spending and welfare, to put our public finances on a firm trajectory, and that's what we did in the budget yesterday.
But how can investors believe that this is a one-off hit when you repeatedly said before the election you weren't going to raise taxes beyond your manifesto commitments? Now you've raised them £20 billion more than the fiscal hole the Tories left behind.
Well, we were left with a terrible situation by the previous government, a big black hole in the public finances, a number of commitments around infected blood and the post office scandal that weren't properly funded. We've now put all of that out in the open, and we've raised taxes in a way that now put our public finances on a stable trajectory. Indeed, the Office of Budget Responsibility confirmed that we meet both our stability and our investment rule 2 years early. That should give confidence, alongside what the International Monetary Fund said yesterday, that these were the right decisions for our public finances and indeed for growth.
That was Rachel Reeves, the UK Chancellor of the Exchequer, speaking to Lizzie Burden just as bond markets, gilt markets were closing up yesterday. Let's bring into the conversation Pooja Kumar, Senior European and UK Rate Strategist at TD Bank, to get her perspective on what's driving these moving gilts and whether Rachel Reeves has said enough. But Pooja, very good morning to you. So if we listen to the budget, as I did, took ferocious, lots of notes, it was very long, quite complicated. We listened through all of that, nothing happened. Then the OBR report dropped, and there was an assumption in there that we get less cutting from the Bank of England, and then we saw gilt yields start to rise. If it's just that that's driving things, maybe that feels rational. But is it just that, the pound not being supported by that narrative?
Yeah, I think the entire price action the last 2 days have been all over the place. First thing in this budget, I think most things were already announced. But I think after the OBR, markets did take into perspective the fact that, OK, there'll be a lot of taxes, but the government cannot actually get that NIC at all without losing more jobs. There will be a lot of spending, but that comes at the cost of issuing so much. Rachel Reeves did actually tweak the debt rule, which was very well flagged. But still, we don't get that much fiscal headroom at the end of the fiscal year. So I think this all got synced into the markets a bit more yesterday than actually on Wednesday per se. I think right now it's purely a BOE game because markets have been looking at the BOE's inflation trajectory, and that's why the sell-off is basically led by the front end of the curve and not by, the average maturity of where gilt yields sit, which is basically 10 years. If markets were really scared about issuance, it would be the 10-year plus sector selling off. But we actually saw the front end because after all this gamble, we will see inflation actually increasing 2.5% next year. And I think that's where markets are more nervous as can BOE cut when we already have a service inflation problem. And we all know that markets have actually removed 2 cuts from the entire cutting cycle from BOE.
Yes. OK, so that's important. So you think this is entirely a BOE game. So this is, because it's concentrated at the front end, 2-year horizon, not the 10-year. It isn't about panic. It's about, and that takes me to, because, the rest of the wider media landscape in the UK is throwing around comparisons with Liz Truss and asking, legitimately, whether we see something similar. It doesn't sound, from what you're saying, as if you think this is in any way similar.
First of all, it's not similar in the sense that the LDI is no longer the vulnerable part of this thing. We do have enough liquidity buffers. But what is my scare is that if this is a spiral move that we see day in, day out, it will spread out across the curve. I.e., you are basically also increasing the debt issuance cost for the government, which means that those 15 billion in fiscal buffer that Rachel Reeves have been talking about, that also disappears, right? So I think for me, it's like, and also if you see that yesterday's price action, it was interesting. Initially, volumes are very low. I mean, everyone is scared ahead of the elections. But suddenly, your volumes increase so much daytime, which suggests that there are lots of non-domestics that are also getting scared. Because if you see, BOE is not buying bonds. Who's buying bonds? It's a non-domestic committee. So I think I'm a bit worried that if we do not see next week's BOE meeting trying to actually calm the market, you could see more non-domestic selling coming off. And I think that's when it won't be just the front end, it would be across the curve.
Does that same logic apply to outside of the UK, this kind of bid from the international community when we're coming to things like OATs, boons, et cetera, when so much of the fundamental issue is quite similar to what you're seeing in the UK in terms of taxation, fiscal headroom, US election risk?
No, totally. Like if you see, markets did punish France a lot. And, like from spreads being 40, they were elevated at 80 for almost 3-4 months. And I think there was nothing new in France's story, right? We always knew where the deficits were. And I'm scared that that does not happen to UK because USD still happens to be a reserve currency. Where we see markets getting more hit is basically France. Germany does not have much fiscal, but, UK comes in the more vulnerable part of the investment horizon.
So you say you knew where the deficits were, and that's completely fair. But I'm curious how much of that was a liquidity story and why, even when this budget in France is not really passed through Parliament just yet, we're still waiting for that final approval, not to mention the EU Commission's approval as well. Why that French volatility has suddenly disappeared? What is the market pricing in there?
The volatility this week.
In French debt, broadly.
Take
your pick.
I think, liquidity volatility is a big part what we are playing right now. Even if you see ahead of this entire UK budget, European bonds sold off aggressively. And I think that basically tells you that markets are liquidating. When it comes to French debt, I think we suffered a lot post-election, but I think right now markets are trusting this new government. Markets think that right now, at least we have gone through all the rating agencies without any issues. Again, that does not mean that OAT versus Bund spreads return to the 40 basis points level, but I think near-term risk is out, and most of non-domestic selling is also out. So I think that's where the risk to the bond market is less, but what is key right now is the liquidity-driven move that we are seeing across the board ahead of the US elections.
Yes, and I wanted to go there actually, Pooja, now with the conversation, because to what degree do we need to be looking across the Atlantic? If we're talking about gilts or talking about other European bond markets, you know, there's a lot of influence across the Atlantic, and if you look at what's happened in gilt yields, for example, since the start of October, yes, some of that might have been nerves around the budget, but also we saw Treasury yields really on the rise, Trump trades being priced in. We have some important data out later on today that's going to be very difficult to read, and then we have the election next week. Is volatility the only thing we can be sure of?
Oh, yes. And we are not talking about the Fed and BOE meeting that will follow the elections as well. No, I think that's the key risk right now, is that possibly if we get a Trump or a red wave, we can actually move another 20 given how illiquid markets are. So even though we feel that markets have been cutting down their long position in bonds, we still have illiquidity issue. And I think that's the key. If treasuries sell off another 20, I don't see gilts underperforming treasuries, but gilts will follow that move. So, you know, even if we get over this Rachel Reeves budget, I think the key risk right now for all markets is that we get a red wave. Markets are more scared about the Trump fiscal. And in that case, even if you see in Europe, even though ECB has been actually on its easing path, 10-year bonds have not been able to rally just because they have such a strong beta to how treasuries and gilts are working. So I think that's the key thing, that even though domestic central banks are able to, you know, control the front end, duration is still clinging on to how treasuries behave.
What does that do then to the dynamic we've seen, I want to say for a year now, where periphery spreads have been more attractive for so many, despite, you mentioned that liquidity story, despite the French OAT market being one of the most liquid markets in the world, certainly larger than the gilt market as well. That dynamic, that appetite for periphery, like credits from Spain, Italy, Portugal, Greece, etc., what does that do going into year end?
I think right now you can see it's waning. You could see peripheral spreads again widening. And I would expect that move to continue unless we do head into an ECB meeting that's super dovish. But at this stage, I don't think I'm playing tighteners in peripherals, because I also know that in January, I will be gifted with so much supply to take in. So I understand if markets want to play the widener trade. And I think that's the best way to go.
Do the budget conversations factor into that at all?
I don't think so. At least the budget is not a big risk for almost all EGBs. Like I've not seen the deficits changing any bit. And as we said, the main key risk for us was France.
Yeah.
Markets so far are actually done with the France story, and they're more concentrating on the UK and the US story. So I think that's where I'm less scared about the budget story in Europe.
Certainly something we're going to be keeping a close eye on. Pooja Kumar, their senior European and UK rate strategist at TD Bank, talking about that dynamic between the United States and, of course, some of the bond story right here in Europe as well, which brings us nicely to some of the other stories that we're following right here in Europe. Spain, especially catching the headlines, deploying 1,700 soldiers to help with search and rescue operations after extreme rain hit the eastern region of Valencia. More than 150 people have died since rainfall began on Monday. Let's go at more from Bloomberg's Rodrigo Orihuela, our bureau chief over in Madrid. Rodrigo, walk us through the latest here. Has the situation improved at all?
That the rains have stopped being as intense as they were on Tuesday. It was a very torrential storm that hit with lots of water, much more than the average for a year in some cases, in a few hours. So in that sense, it has improved. The problem is now the consequences. There are still a lot of places that don't have electricity, don't have phone or internet connections, and there is a lot of places where you don't have water, you don't have food, so rescue efforts are focused on bringing food and water to those people, also getting people out of places where they are trapped. And finally, the most tragic part is that there's still a lot of questions about how many dead people will still be found. There is likely to be dozens of bodies still trapped inside of some of these towns.
Yes, indeed. And that takes us on to the political consequences of this, Rodrigo. What are you hearing so far? I mean, I've heard people asking about warnings and whether they should have been sooner, people given more notice. How much is this sticking to the existing government?
So in Spain, there's a very decentralized political system, and the final responsibility for the alerts, for the civil emergency alerts, falls on the regional governments, which are broadly equivalent to states in the US. And in this case, the weather agency had issued an alert close to 7 a.m. That's the national weather agency. But the local government didn't issue its own, which is the one that goes out to all mobile phones, till 8 p.m. So there's a lot of questions as to why they took that long. But right now, most politicians have been very careful as how they tread around this issue. One thing we have seen is that yesterday afternoon, the national government, as they announced the deployment of soldiers, also said that one of the ministers will personally be involved in the regional government's committee which manages the crises. And this specifically, this actually means that the government is effectively taking control of the situation and taking some of the control away from the regional government. As far as the fallout goes, the leader of the opposition did yesterday basically point his finger at the prime minister, but everybody else has been very, very careful and not to kind of bring this to the political fray yet.
Rodrigo, thank you very much. We're looking at live pictures of Valencia as that clean-up continues. Bloomberg's Rodrigo Orejuela in Madrid. Thank you for bringing us that update. 7:46 here in London. We will return after a short break to some of the corporate news stories that we're following this morning. Coming up, the streaming sales help boost Universal Music Group's recordings revenue. We will check in on that and other stocks that we're watching this morning. This is Bloomberg. Welcome back to the opening trade. 10 minutes until the start of equities trade. Let's think broadly about risk appetite this morning, shall we? Bloomberg's Rachel Evans joins us, managing editor for FX and rates coverage for the US and EMEA. Rachel, the market's in 3 minutes. Where should we start? Do we start payrolls or gilts? Payrolls or gilts? I think we'll go with payrolls. Also exciting this morning. So the payroll story is going to be very difficult to read later on today, isn't it? Because of all of the sort of one-offs.
Yeah, absolutely. I think that the strike action that we saw for Boeing workers, plus the hurricanes, Helene and Milton, are going to make it very, very unclear. We've got a huge dispersion of estimates in terms of exactly what people see. I think the mid is really 100,000. That would be, I think, the lowest in 4 years. But yes, it's going to be a question of how much the market kind of looks through that, given that jobs have been such an important part of how the market, at least, has been viewing kind of the Fed and whether they are going to cut again in November this month and whether they are going to cut again in December. We've really seen a massive recalibration in October. We've seen a lot of bets taken out of the market. We're now seeing about 4 or 5 cuts through the end of next year. And I think the big question for markets, from this report and then heading into next week, where, of course, we see the Federal Reserve meet, is are we now in the right spot? Given what we're likely to see in the labour market, if we manage to look through this noise, do market bets accurately represent what the Federal Reserve is likely to have to do over the next year or so?
Anna was looking forward to the payrolls report. I'm going to look backwards for a moment. Why did we not see a bigger reaction to the PCE data?
Yeah, I mean, inflation has been less of a focus for investors, given that jobs has been so important. But I think it's really that a lot of those figures kind of were very much in line with what people were anticipating. We saw ever so slight stickiness on the kind of core year-on-year space, but really they were very much in line. So there wasn't anything particularly new for people to trade on. I think the data today is going to give people something new to trade on. It's just a question of to what degree people feel that they can take a strong bet at all, given that we obviously obviously have the election before we even get to the Federal Reserve next week.
Let me ask you about gilts then, Rachel, because this has been a real preoccupation of the week. We've seen those gilt yields on the rise, not taking the pounds with them, perhaps crucially. We spoke to Pooja Kumar of TD just a moment ago. She was saying this is all Bank of England related for now. It's more at the short end than further along, but it can spread along the curve. And that's what worries her a little bit. And there's also US election risk. If we get higher yields on treasuries, what that does to gilts.
100%. I think this is all about coming to be all about momentum and confidence overall. Because as you point out, we've very much seen this move being concentrated at the short end. It's been the 2-year that's really been repricing. And that's a reflection of kind of some of those higher inflation forecasts, meaning that the Bank of England likely won't be able to cut as fast as people had been anticipating. So that's why we've seen the recalibration. But the problem comes if that starts to spread further out in the curve, and we do have supply risk as well from all of those debt plans to fund the budget.
All right, Bloomberg's Rachel Evans, we thank you so much. For Payrolls to PCE, she does a little bit of everything. Let's go from the macro to micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we got a key court ruling in the US last night for Reckitt, Benckiser and Abbott Labs, which has won a big case known as the Whitfield case in their infant formula ruling. That was a big overhang for this stock. We see a big drop in Reckitt earlier this year on news that they could potentially face billions in compensation, and this is a key court case for them and a big win. Then in terms of the semiconductor stocks, it's mixed reports out from the US. We have seen Apple weaker, but Intel did jump following their numbers, and Samsung also dropping a bit over in Hong Kong. Now, in terms of what's the drivers of those, bit of uncertainty around China and the AI as well, but these stocks obviously down a lot over the past month, potentially rebound ahead. In terms of Universal Music, this one looking strong, a recovery in some of their streaming numbers after a collapse in growth last quarter. That's the drop we can see on the screen there, but a bit of a rebound potentially going to help some of the bullish analysts on that one today. Then in terms of rating changes, we got an upgrade for SocGen. That's after that massive rally after earnings yesterday, and then a couple of downgrades in airlines, Lufthansa and Repsol, over in energy, all of those in focus today.
Lots to watch then, Joe. Thank you very much. We'll also keep an eye on Tesco returning a bit of cash to shareholders after an asset sale. Lots to talk about this Friday morning, even if it's a little quieter on the earnings front. At least it is Friday. This is Bloomberg. Welcome back to Friday's opening trade. A few minutes to go until we get the start of that trade for equity markets and crucially for gilt markets. We'll certainly be keeping an eye on those this morning. Casting our minds back to the session of yesterday, though, this is the legacy. This is what we are given to go into this session with. This is the European equity markets in the white line and the US equity markets in blue, and kind of mirrored each other towards the end of the European session. US markets did take a drop towards the end of their session, so we'll certainly see if we get any of that. That's not the sense we're getting from futures, though, this morning, whether that's stateside or here in Europe. The futures picture does look slightly positive. FTSE futures up 0.1%. UK markets were weighed down a little by jitters in gilt markets yesterday, so we'll certainly see if we get any unwind of any of that theme, and we'll bring you the open of those gilt markets when it happens in a minute or two. So stock market open very much in focus, gilt market open very much in focus. Then, Kriti.
A couple of individual stocks to keep an eye on as well. We've always had one eye, Anna, on the car sector, and again, today is no exception. Volkswagen, Renault going to be in focus. Those French car registrations down about 11%. Again, 28% on a year-over-year basis, so perhaps getting kind of factored into the auto narrative as well. Reckitt Benckiser, as Joe Easton was telling us a few moments ago, also very much in focus. It looks like they have actually gotten cleared in a formula trial. We're going to see how the market appreciates or maybe does not appreciate what that actually looks like. This, of course, in relation to that trial with Abbott Laboratories as well. And the Universal Music Group, you are seeing them, their revenue beat estimates, a lot of that subscription growth really helping their bottom line. But net, it's not that earnings volatility that we saw in the last couple of days, Anna, but perhaps some spots of green in today's individual stock market.
Yeah, we had plenty of earnings volatility over the last couple of days, didn't we? Not to mention macro volatility in the gilt markets having an impact on UK listings. We've had some tech earnings after hours. Apple to the upside, to the downside, and Amazon and Intel moving in the other direction. Let's see how any of that plays out into the European equity market session. The FTSE 100 first out the gates and pretty flat this morning. Maybe that's something of a relief given all of the volatility we have seen in UK assets up to this point. The IBEX pretty flat, Stock 600 then fairly flat. As we say, without some of those corporate earnings drivers that we have had plenty of, Wednesday, Thursday in particular. We do have that tech theme to play, although the read across into Europe is often a little unclear there. But we have had that mixed picture really coming through from tech, although Nasdaq futures do point a little bit higher, perhaps reflecting a little bit more the positivity around Intel and Amazon rather than negativity around Apple. So the CAC 40 is up by 0.2%. The DAX open up a tenth. The FTSE 100, as I say, up 0.2%. So we're seeing modest gains at the start of Friday's session. Kriti, what do you see when you look beneath the hood?
I'm trying to find a common narrative here, but I think when you talk about some of the sector positioning, it is mostly green on the screen, at least when I'm seeing on my board. A little bit of a mixed picture, though, when you go kind of underneath the hood. When you look at your biggest index contributors this morning, it does seem to be your heavyweights. Novo Nordisk taking the cake for the Stock 600, again, in terms of index contribution. Then you've got a couple of energy names. Remember, energy has kind of had a very volatile week, so perhaps Shell, Total, et cetera, actually gaining on perhaps that macro narrative as well, where you are seeing Brent crude higher by about 2%. That getting magnified in the stock market as well. We are also seeing Universal Music Group, which is one stock we had our eye on, higher by 4%. But to the downside, again, it really is an array of different moves. Again, the DAX isn't quite open yet, but you are already seeing early trades on the likes of Volkswagen, Renault, even Ferrari under pressure, perhaps from the registration data.
Let's have a quick look at what's going on in gilt markets, because this has been a focus for markets this week. We are seeing gilt yields continue to rise this morning, not by the same amount as yesterday, but we do see it, and we see it across the curve. So at the 2-year horizon, we're up by 3 basis points. At 10-year, we're up by 3. In fact, we're up by 3 basis points across the curve. We saw yesterday a move of 9 basis points at the 10-year, 12 basis points at the 2-year. Interesting that we are seeing moves higher in yields across Europe today, but the gilt move does stand out just a little as slightly more. But it's kind of more in the mix than it was yesterday, maybe a little more in the mix than it was in yesterday's session. Interesting, Pooja Kumar giving us that context that a lot of this has been at the short end up to now, and a lot of it's been a revisit of Bank of England rate cut expectations. But her worry was that this spreads across the curve the longer it lasts, essentially.
It's certainly something that we're going to be keeping an eye on. Let's take a quick check at some of the early stock movers as well that we are starting to see. Prosus actually taking the cake here, higher by about 1.8%. I know you recently had a conversation, I believe, with their CEO as well. But to the downside, you are seeing National Grid, you're seeing AXA as well. Remember, AXA was moving yesterday as well off of the back of some of the French earnings from BNP. They're dealing with a little bit of a takeover in their asset management story as well. And Unilever as well, down about 0.3%. Also kind of under pressure, but I'm not seeing the same volatility that we saw. If there is a story to take away from today's trade, it's Shell, Total, BP seem to be the outperformers. That really, again, a function of what we're seeing in the macroeconomic space, all as we're digesting some of the earnings story. We talked about this with Sharon Bell, senior European equity strategist at Goldman Sachs yesterday. Take a listen to what she had to say.
We don't expect much earnings growth next year, 3 or 4% for the next few years for European companies. This year, you're right, earnings, I don't think the earnings season's been too bad so far, but that's partly because the hurdle rate was quite low. People were revising down beforehand. Buybacks, although they'll be quite strong next year, I do think that they probably peaked this year. The momentum in buybacks has really accelerated in recent years. I don't think it will go back to where it was, say, pre-pandemic, when we didn't have so many buybacks in Europe, but this year's probably the peak.
Let's get another perspective this morning. Morgan Deldon, head of investment strategy over at Global X ETFs, joins us around the table. Pleasure to have you on the program. We were talking to her, to Sharon, yesterday just about that earnings read-through as well, specifically that when we're getting so many, it feels like signals from the United States, but I think what we're struggling with is how they apply to Europe. Today's a great example. Major tech earnings in the last 24 hours in the U.S. Does the European market care? Should we be caring?
I think all eyes are on tech earnings because they are a massive driver of growth. So all the earnings volatility we saw this week shows that investors are waiting to really see signs each earnings season of the monetization of AI. And it is incredibly divergent within the Magnificent Seven group in terms of outlook and how it is received and perceived by investors. You see that, for example, Google and Amazon performed strongly, but on the flip side, Microsoft and obviously Meta, they were quite lagging. So I think investors now are less optimistic overall around tech, but more scrutinizing how quickly these companies are translating their massive AI investments into profits. So given that valuations are also very high, I do expect that volatility around earnings season keep happening each earnings season, even next year.
When it comes to, there's the earnings season and there's kind of that bottom line. It feels like the tax policy on both the United States and Europe is going to factor into that. How do you quantify that? Is there a direction this is moving in? How marginal or material is that hit?
Well, it's going to be a key determinant for next year, but obviously, it depends on the outcome from the election in the US, because in the event of a Republican sweep, which is now the most likely scenario priced by markets, we could imagine that Trump's deregulatory policies would help some of the tech sector and give a boost, at least in the short term, in this industry. This coupled with potentially an extension of tax cuts for major companies, that will give an advantage to US tech stocks compared to their European counterparts, for example.
Morgan, how does that add up to your outlook for 2025? If we can look into the crystal ball a little bit and look through a host of incredibly consequential events, not least of which is the US election that takes place just next week. But looking through all of that, what are you expecting for 2025? Is it too early on November the 1st to have that conversation? I don't think so.
I think we're definitely going to get some clues next week with the most likely scenario of maybe a Republican sweep, and what it's going to translate into fiscal policies, economic policies, and so on. But what we can say is it would be quite reasonable to assume that next year we'll see a stabilization in terms of rate cuts, given that we are witnessing a soft landing in the US, and in Europe we are also very close to neutral rates. So I think that given the uncertainty economically, but also geopolitically, central banks will continue to give some support, but I don't see currently some deterioration that would imply more rate cuts, at least in the second half of next year. So by mid next year, we should see more stabilization around neutral rates.
Yes, and so you think that red wave story, that's enough to play out strongly for stocks rather than focus attention on the rate cuts we won't get and then be negative for stocks?
Right. What we can expect, like from past election cycles, is that after the election we might see equity volatility declining, because in the event of maybe Trump winning the election, usually the market will receive it as quite friendly. So that should give some less uncertainty, at least in the short term. But longer term, it means more potentially questions on the bond market and the fiscal stance in the US, but also on the inflation outlook. And we're seeing inflation expectations already rising since the beginning of September, when the scenario of a Republican sweep became more likely. So I think we'll see a dichotomy between the bond market and the equity market after the election.
So that's the fundamental kind of narrative around it. But how much of this is really at the whim of liquidity? The idea here that if you have volatility, regardless of what happens in the U.S. election, you've got 2 wars in this region alone, is there a bull case for the United States purely on capital flows, flowing out of Europe, flowing out of Asia, given that defensive trade? Is there that regional divide?
Absolutely. I think we can really grab this view when you look at what's happening on the gold market. Like you see gold at all-time highs, and at the same time optimism around U.S. equities. So it's definitely showing that there is some defensive trade in the market. And at the moment, economically, the U.S. is outperforming Europe, at least on the economic side. And so investors are trying to see where they can have more safety, and the U.S. is still perceived as a good defensive trade, especially in the context of heightened geopolitical risk that should continue next year.
OK, even if the geopolitical risk comes from the States is a haven. Is that the way? It's been that way in the past, so, maybe it doesn't change.
Absolutely. I think at the moment also the development in the Middle East make it more uncertain around what's going on at the global level. The trade tension potential trade tension with China, another factor of risk. So at the moment, it's not like where is the best place. It's more like where is it the most safe.
The least worst.
The least worst.
Yeah.
How much of the U.S. election affects the Fed's rate path?
It shouldn't. But obviously, I think in the short term, there will be not major impact because in both scenarios, we can see if Harris wins the election, we'll see probably a continuation of Biden's policies and therefore moderated growth, but not major change in economic trends, so no major impact on the Fed's view. However, on the other side, where if we've got a Republican sweep, we can expect that in the short term there won't be major impact on inflation, but depending on what policies will be on tariffs, that could massively impact the inflation expectations, and down the line maybe a question more for the second half of next year, how that will impact Fed's view on rate cuts and maybe like changing direction.
And certainly one that we have to keep an eye on in terms of what that policy actually looks like. Morgan Del-Don, head of investment strategy at Global X ETFs, joining us around the table this morning on an array of factors that are moving this market. In the meantime, let's get a quick check on the core six, a sensational six, if you will, the heavyweights, of course, that might be moving the European market. You are actually seeing Schneider Electric seems to be the outperformer, higher this morning by about 1.4%. I'm curious how much of that is an Amazon AI story as well. To me, what's sticking out, those Ferrari, down about 0.5%. I never really talk about Ferrari, but today, those French car registrations seem to be having quite the effect on a broadly kind of risk-on market when it comes to some of those car makers. Ferrari is no exception there. Even ASML kind of taking down about 0.2%, but not the major move that we are used to. That is a look at your core slicks. Let's check on some of the other individual stocks on the move. Joe Easton standing by. Joe.
So we're seeing Reckitt Benckiser today rising the most in 16 years for this company. It's the most since 2008. It's up 10%. Now remember, a court overnight did rule that the company was not liable for a illness in a baby that tragically was ill with a bowel disease following the use of one of their baby formulas. So that is what the case was about. The jury said they did not agree with the science behind the claimant's case. The claimant was looking for $1 billion in compensation, and that was rejected. So therefore, we are seeing Reckitt now coming back following this big drop in the stock. The stock had actually lost around $8 billion worth of market cap since these claims emerged around this baby formula case. The key for that company today. Then the other one that's moving pretty sharply higher, coming down a little bit at the moment, Universal Music seeing a rebound in their streaming numbers. Now, this did collapse in the last quarter, as we said earlier, possibly due to the rising interest rates, but that is coming up at the moment in terms of Universal stock price today on that rebound in streaming. Then in terms of chips, this is a more difficult one to get a read on, given we had those reports. We did have Apple coming down very slightly in the post-market. We had Intel going the other way, jumping. Samsung was weaker. Lots of moving parts, potentially some weakness in the China growth on a lot of those stocks, and also a bit of uncertainty around AI, also particularly with Intel with some of the supply issues that they've had at the moment. But those stocks pretty much trading in line with the market at the moment. In terms of your broker moves, SocGen, we said earlier, now this stock coming off its best gain in around 2 years, was up around 12% yesterday, and analysts over at Morgan Stanley recommend buying that one this morning. We will then flip over to one more I think we've got on the screen to bring up. This is probably not going to be my day. Oh, there it is. That's helped me out. Ixtron, this one is cut at Jefferies. Again, we're over in semis, but Jefferies saying that they do not see any strong reason for a rebound in a lot of these semi stocks at the moment, given that continued uncertainty around China. So this one is declining 2.7% over in Germany this morning.
Joe, have faith. Joe Easton from our equities team being ably supported with the graphics. Coming up on the programme, we'll get back to some of the tech themes we've mentioned in passing so far this morning. Big tech divergence. Amazon shares jump on an earnings beat, but Apple seems to disappoint some around China. We'll have the details next. This is Bloomberg.
iPhone grew in every geographic segment, marking a new September quarter revenue record for the category. And services set an all-time revenue record, up 12% year over year. We also set September quarter segment revenue records in the Americas, Europe, and the rest of Asia Pacific, as well as in a large number of countries.
There we go. The Apple CEO Tim Cook speaking on the earnings call, positive about various products, positive about various geographies as well. Let's see how that is playing out for Apple, though. Not quite so positive, but just down 0.9%, which on the scale of tech moves post-earnings, maybe not so huge, but a little bit of room for improvement perhaps there, certainly in comparison to Intel and Amazon, which are both on the rise. Let's get more details on those. Intel CEO Patrick Gelsinger spoke to Bloomberg Technology about the company's turnaround plan and commented on reports that rivals ARM and Qualcomm are eyeing some of the company's assets.
We don't view any of these rumors as particularly meritorious. We laid out a strategy. We reaffirmed that with our board of directors. And obviously, as we've taken these steps this quarter and restructuring and getting our costs where they need to be, we have the capacity to go on the journey.
Intel CEO Patrick Gelsinger speaking there. Let's bring into the conversation Bloomberg's Amy Thompson, who covers European or tech in Europe with a global lens. Amy, very nice to have you with us. So let's start with the Intel story. Pat Gelsinger saying to the team yesterday that they are undertaking the most audacious rebuilding plan in corporate history, which is quite an audacious claim. But we saw a big move in the share price. So what is it that's been going well at Intel, at least in the last 24 hours?
Yeah, I mean, the story with Intel is that they kind of went left when NVIDIA went right, and they've been paying for it. So the quarter before this one was the reckoning. We saw the job cuts, the cost cuts, the factory delays. And it seems like things are starting to turn around. I mean, their outlook for the year was on the profit side, something like twice what the street was expecting. It seems like the cost cuts are going well. So I guess now it's up to Pat Gelsinger to prove to his investors that he can hold things together and turn it around without breaking up and selling to somebody like a Qualcomm.
And in the meantime, Apple and Amazon, a tale of two very different tech stories in the last 24 hours. Let's start with Apple there. The shares, as Anna pointed out, are not down as much as traditionally expected with post-tech earnings. What's going wrong and what's going right with Apple?
Yeah, I mean, they had a new iPhone out in the quarter, but they're dealing with a really sluggish smartphone market, which we've seen trickle through to several earnings this time. And also another big theme for big tech this quarter has been China. Where Apple itself found a lot more competition from Huawei and their new devices. So potentially not as much, of excitement around the new iPhone as you'd hope. But I think people are pretty optimistic going into the new year because there's going to be new, cheaper SE model. It'll have Apple Intelligence on it. So that might give them a bounce next quarter.
Yeah, really interesting to see what that Apple Intelligence does, even if it's going to be rolled out slowly. Also interesting that Tim Cook was he just refused to answer any questions on tariffs yesterday, didn't he? Certainly didn't want to do that, so he's not going down that road. Let me ask you about Amazon, because this is a really fascinating case, isn't it? Sometimes tech investors get spooked when they see big capex, they see big investment, and they're not sure when they're going to see the returns of that. We've seen that in the past with Amazon. But this time around, do they have investors on board? Because they are spending a lot on capex, on AI, on data centers.
Yeah, we've seen a lot of, it's another big theme this quarter has been the big AI investments that we're seeing from big tech. What Jassie's been doing over the last several quarters is taking this mammoth logistics operation that they're famous for, of course, and streamlining it, pouring that money back into the cloud, into data centers, and that's allowed them to really take advantage of this huge demand for compute from the AI boom. And you saw that with Google, for example. Very similarly, they put a lot of emphasis on spending money on data centers, and they reaped the benefits this quarter. Their rival, Microsoft, wasn't able to keep up quite as well and had kind of a disappointment there.
All right, Bloomberg's Amy Thompson, we thank you so much for giving us the tech roundup this morning. Let's go to another major heavyweight, perhaps on the S&P 500, but certainly in the Dow. Boeing, of course, those shares higher by about 2.5% in the pre-market trade this morning. It comes as that alongside union leaders representing 33,000 striking workers have reached a tentative agreement to end their dispute. Now, the deal would boost wages by about 38% over 4 years and give workers a $12,000 signing bonus if it is indeed approved by members. Joining us now, Bloomberg's Sid Phillips. We've been here before, having a little bit of deja vu. What's the union saying about it?
So the union is actually saying that this time, please accept the offer because this is the maximum we think we can get out of the company. And the company may not have an offer that's as generous as they go forward. And so there's a vote scheduled for Monday, and that will really decide whether or not the workers will accept that deal. and that will basically determine whether or not Boeing can actually start producing planes again.
OK, so we look ahead to that vote. I mean, Sid, you say that this is the union saying quite forcefully you should accept this, but haven't they, the union leadership have been in favour of these deals in the past? I think it was 2 deals ago. They thought it was a good deal.
Exactly.
So what does that tell us anything material?
It actually determines whether or not the workers are sort of getting fatigued with striking, because I think that's really key. Because we're getting into the festive season, Christmas is coming up, and there's going to be expensive purchases on the way. And so will the workers be willing to sort of accept the deal, take the big ratification bonus, and get producing planes again? Or essentially, will they be sort of still looking out for more? Because they have been asking for the pensions to come back. They've asked for 40%, which is quite close to 38% that Boeing has offered them. And so it's really a question of how they get there, and they can sort of whether they can bridge that little gap there.
What is the doomsday scenario here? I mean, this is coming at a time when Boeing's already bled so much cash as a function of these striking workers. They have a $19 billion capital raise, a really fun combo of stock dilution and bonds as well. What is the doomsday scenario here if this doesn't go through?
I mean, Boeing can't really generate any cash unless they can actually get planes out the door. And they can't build those planes to get them out of the door until the workers actually come back. And unfortunately for Boeing, they need the workers there to actually build those planes. And so the company really needs to get a deal across, and so that they can actually start producing planes again, start rebuilding that cash position, and basically being able to sort of pay down their debt and be able to sort of work on future products. So this is imperative for Boeing. Boeing needs to get a deal with their workforce, and I think they understand the sort of urgency of that, and which is why they've sort of agreed almost to what the workers were asking for.
All right, Bloomberg Sid Phillip, of course, standing by and watching that entire negotiation tick by tick. We thank you so much. But Anna, it's these Boeing strikes that are going to show up likely in the jobs numbers as well. We're going to see later today, not to mention the hurricane impact of both Helene and Milton as well. But the Boeing numbers are not only 33,000 people, that as Sid was just laying out, but that's pretty material to a 136,000 whisper number that we're expecting.
Yeah, absolutely. So I think we were hearing from Valerie earlier on. She was saying the Fed is looking at these two sort of one-offs, the hurricanes and the strike action, and lumping them together. If you think about 100,000, maybe that's what's taken off the payroll creation as a result of this. That was the Fed's take, according to Christopher Waller. We heard from Abigail Watt, though, at UBS. She had a slightly lower number in for that. It was around 40,000, I think, for the combination of those two things. So we'll see how that plays out. It is interesting that because of these complexities, maybe even more focused this time around, not on the job creation numbers, but on the percentage of unemployment, because that comes from a different survey, which is, according to some economists, and Abigail picked up on this, it is going to be more resilient or more a cleaner read, maybe, that 4.1% unemployment rate, if that holds.
Not to mention the wage growth associated with all of that. And we should also mention that even though this data set, as you point out, might be an anomaly to what we've seen in the last couple, given kind of these external circumstances, or exogenous circumstances, I think is a better word to use, the last couple of prints have come in significantly hotter than even the whisper number or the survey number. So the beat to the upside seems to be where the real risk is. And perhaps that's why we're not actually seeing as much of a reaction on the back of the PCE numbers in the last 24 hours that we did.
And taking that global, I think that's really interesting. If we do see that outperformance, if yields go higher in the US, and if that spreads to Europe, that's caused problems for gilt markets in particular of late, so we'll watch that.
Monday morning is going to be really fun for the show. Tune in if you're around. Coming up on this program, though, in the next few minutes, we talk about European competitiveness through the lens of the upcoming U.S. election, more on the potential policy pivots from each candidate and what it means for Europe. Tommaso Valetti, former chief competition economist over at the European Commission, joins us next. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session, seeing broad gains, when it comes to the equity market across Europe. But you're also seeing a bit of a rise in yields as well. That's certainly something we're going to be keeping our eye on, as, of course, budgets and elections are the focus on both sides of the Atlantic. Let's zero into that election component and bring it to our daily focus and the issues facing Europe in the battle between Kamala Harris and Donald Trump. Today, we dive into technology and competitiveness. Oliver Crook, of course, keeping a very close eye on this, is here to walk us through where Europe stands on the topic. Ollie, take it away.
Yeah, that's right, Kriti. So we got that Mario Draghi report, which is really supposed to be the template of how to sort of solve, first of all, analyze the problems that Europe has and how to solve them. And really the biggest problem that Mario Draghi points to is this enormous gap in both technology and productivity that has emerged between the United States and Europe, and that has really blown out over the last couple of decades and accounts for a huge quantity of the sort of GDP growth that has been lost here in Europe. He points to the fact that in Europe, there has not been a single company in the last 50 years that has been founded that has a market cap that exceeds $100 billion. Every company in the United States that's over $1 trillion, there's 5 or 6 of them, were founded in the last 50 years. And the productivity issue becomes all the much closer to home when you think about it by the fact that in 2040, we're going to be losing about 2 million workers every single year from the workforce, which means that every single worker needs to be that much more productive in order to get the sort of levels of growth that Europe needs basically to survive and to compete economically, to say nothing of the difficulties of defense and energy brought on by the war in Russia and Ukraine. The solutions that he proposes to these problems, very, very broad level, is that you need a Europe that is more unified. You need a Europe that behaves a lot more like a single country rather than a collection of different nations. He also points to the fact that there's a huge gap in the R&D spend between Europe and the United States, about 270 billion euros. But it's not just the volume of money, it's where that money is being spent. In Europe, the top 3 R&D spenders are all in the automotive industry. What you have in the United States is it's all in tech, and that is what you need here in Europe, to say nothing of the fact that basically you are losing about 1/3 of your unicorns every single year, most of them going over to the United States because the conditions are just much more favorable for startups there.
Okay, and Ollie, what are the hurdles that Mario Draghi's recommendations face?
Yeah, so listen, this is the sort of document that Ursula von der Leyen had requested from Mario Draghi in order to basically inspire this new European Commission. This is the document that's supposed to lay out what the economic framework is going to be. The issue that you have there, despite the fact that many people seem to agree on the issues Europe has, the solutions the people do not seem to agree on quite as widely. You have the issue of the fact of the rising nationalism in a lot of the key driving European nations, here in Germany, over in France. You have the difficulties. We found very concrete examples of getting something like a banking union when you have UniCredit coming in to try to buy Commerzbank, and the German government says, actually, we're not so interested in that. Issues on trade, there is not a unified front on the question of China and how to approach that. And of course, the question of joint debt, which is one of the most powerful sort of tools that could be helped to enlist to get some of these things in action, is always a very thorny subject. Now, the question becomes, with this new European Commission, are we in a position to basically face the new paradigm that Europe is facing down right now? Or is it a recipe basically for more paralysis? Mario Draghi giving a very stark analysis saying, don't lie to yourselves. Do this now, or it's a slow agony for the European continent.
Olive, thank you very much. Oliver Crook in Berlin with that reminder of what we heard from Mario Draghi, his prescription for change and the hurdles that could stand in the way of change. Let's continue that conversation with one eye on the US election, of course. Tommaso Valetti joins us, Professor of Economics at Imperial College Business School and former Chief Competition Economist at the European Commission. Tommaso, very nice to speak to you. Thank you for joining us. So we've heard from Mario Draghi. He has an idea about what he thinks Europe should do, how Europe should change to prepare itself for the sort of great competitiveness agenda that sits in front of it versus the US and China. How does the US election and the likely result, how does it complicate Europe's efforts?
Well, I wouldn't say it complicates Europe's efforts, because Europe is trying to mimic what the US has been doing for the past years. So the complication may be specific to antitrust, and we may discuss about that. The relationship between the US and Europe in the past administration have been good, have been on the rise, so we will see. There's lots of uncertainty next week for the elections. But Draghi, I think I should say the important thing of Draghi is not just some recipes he's saying, but he's saying you should look at the unified approach. Europe has a big asset, which is a common market, and we are not exploiting it to the full. So we have to join industrial policy, which we haven't done for too long. The US instead have been doing industrial policy, trade policy, and competition policy. Europe had typically a bit of a silos approach to each one of them, and instead we have to join them up.
It's interesting because years ago we used to talk about Europe instinctively liking to do industrial policy, and perhaps from an Anglo-Saxon economic perspective maybe being too interventionist in its economies, and maybe that changed over the last 10, 15 years or so. But now the US is doing it, gives Europe sort of carte blanche to go back to doing that. What does that industrial policy then need to look like in Europe?
I think Europe did probably the wrong industrial policy. So if you compare numbers, the type of public investments in Europe and in the US are not dissimilar. So they're similar numbers. What happens in Europe is that public R&D is not matched by private investment. So we're lacking, as if it is crowding out. So this is sometimes, and that's my conjecture, some money has been given to firms that would have done those investments anyway. Okay? So we don't have a joined-up industrial policy. To be more clear, the typical subsidies that state aid has been given, and since I was working for the Commission, I've seen it from the inside, was more a reflection of the distribution of power of individual countries. So Germany comes first, followed by France, then third Italy, and then Spain, instead of having a common European project, and we're investing in something which is meaningful. So if we can change that mentality, this could be a game changer for Europe as well.
Emmanuel Macron has been very vocal on this very topic, and in terms of subsidies and competing with the likes of the IRA. Can the likes of France, Germany, other European nations compete with the likes of the IRA given the fiscal handcuffs?
Well, overall, Europe is a market of 500 million people. Europe is rich. There is money. It's just to spend that money wisely. Now, it was said earlier that we keep investing money into cars. Yes, it's a core industry, but there is more than that. So we have to react. We have to take priorities. We have to be more ambitious, and we have to have an industrial vision. And this is something that Mario Draghi is asking us to do. Whether the European leadership can do that, it's another question, but it's a very good point.
You bring up the industrial policy, but you also mentioned antitrust as well. It's fascinating to me that you're starting to see so much of this idea of we need to bring tech and we need to have a European kind of answer to Silicon Valley. And yet so much of the regulation and the pushback from that is coming, it seems, on the surface from the likes of the Competition Markets Authority here in the UK. But then, of course, the European Commission, Margaret Vestager, seems to have a chilling effect on the innovation. What do you say to that?
No, I wouldn't disagree with that perspective. So in big tech, the world is dominated by a handful of firms. So as part of a discussion, we are talking about resilience. We're talking about also independence. Most of European infrastructure is not even European. So I think it is a big economic problem and geopolitical problem. So Europe started to tackle the dominance of some of those tech companies years ago, but then they stopped. And in the past, there was a narrative that Europe was anti-American, but instead, in the Biden administration, you saw many cases which have been run actually by the FTC, by the DOJ. So that narrative, we can put it on the side now. So we will see whether the next administration will continue with that kind of agenda or not. But in recent years, if anything, the US has even surpassed Europe in terms of trying to tame the big tech companies.
No, it's a fair point, and I think the European Commission, it also feels like has kind of paved the way for that Europeans can't lead the regulation on American companies, so it's created that move. But as a function of that regulation, I'll give you a case study. Apple, for example, is no longer releasing their same products and the same new technology in Europe for that. That harms European consumers in terms of their access to that global technology, no?
Well, you have to be careful. There's lots of hype. There is lots of also announcements which are made. And some of the AI which is not released in Europe is something which is irrelevant still in the market terms. So you have to be a bit careful when the companies, because there is a big regulatory game and lobbying game going on. The bigger problem is that there is lots of European talent, lots of European startups. They do exist, but typically they are immediately bought by American companies and they move over the other side of the Atlantic. So as I mentioned earlier, we have assets, but sometimes these assets are not European any longer. So the key question for the European is what to make in order to make sure that those assets remain in Europe, and that's a fair question.
Interesting. So that's interesting on the US tech side. What about the role of China right now, Tommaso, and what we watch there? Because we started this conversation talking about this in the context of the US election. Clearly, we could end up with a US president who is once again even more tough on China, I suppose, certainly on a tariff perspective. But you've done some analysis. You've looked at analysis of FDI into Europe and whether Europe is trying to block Chinese money coming in, and you don't find evidence of that. Do you think it's going to stay that way, or will that change?
No, it's going to change. And in trade, we should expect trade wars, both with China and with the US, because there's going to be lots of bargaining at the trade level, and you can bargain if you have a good set of cards. But Europe at present doesn't have a lot of cards unless they try to protect their own intellectual property. our own European data about the way we travel, our health, etc. We are not going to give those data to the US companies. Otherwise, we have nothing left for any further negotiations. So I do expect trade wars to be more, to have more friction.
That's really interesting. So we expect trade wars, and you think data is an important bargaining tool when it comes to settling those trade wars?
Yes, because it will take time to build physical infrastructure, and I think Europe will want to get there. But now, immediately, what do we have? Us, the people, the data we generate, and it is transport, it is health, it is energy consumption, energy patterns. So these European data are very valuable.
What levers does Europe have, though? If we're talking about this trade war, we're talking about these tariffs, and we're also talking about the effectiveness of whether a carrot or a stick is more effective. What levers, what retaliatory levers can Europe pull when it comes to the United States should, say, steel tariffs don't get put back on?
I think they're trying a bit of that, of course, but there is also this, the industrial policy lever that we will have. So Draghi is talking about 800 billion euros to be invested. That's a lot of money. If you do it well, that has a big power to change lots of industrial sectors in Europe. It will take a bit of time, but that's the direction Europe is going. There is a new European Parliament, new Commission, new mission, and they have to deliver on that.
OK, Tommaso, really good to speak to you. Thank you for visiting us this morning. Tommaso Valetti, Professor of Economics at Imperial College Business School and former Chief Competition Economist at the European Commission. So we've seen it from the inside. 8:41 here in London. A reminder that we'd really like to hear your views about the show, about our programming, about what we've put together. So if you want to get in touch, if you want to have your say, you can do that. Click on the QR code that's on the screen right now to tell us what you would like to see more of on Bloomberg TV and anything you would like to see change. We will use your feedback to make the best programmes that we can. Let's get back to the corporate agenda, Kriti.
Yes, there's a stock that is moving quite aggressively here, and that, of course, is Reckitt Benckiser. It looks like it's coming off that baby formula trial win. The shares are higher by a whopping 10% in the European markets. Abbott shares are higher as well, as high as 6% in the pre-market. So you are seeing a move again in response to the trial verdict there. Coming up, we're going to bring you the broader consumer story out of Europe. Bloomberg Intelligence seeing value segments taking the lead. We're going to dive into the details. Stick with us. This is Bloomberg.
Welcome back to the opening trade. 46 minutes into Friday's opening trade, and we see the European equity markets are making some modest gains across the different geographies today. In terms of the US futures picture, that also looks to reflect a similar amount of positivity. Certainly on Nasdaq futures, we're up by 0.4%, perhaps taking their clue from some of the more positive tech earnings, the likes of Amazon and Intel, rather than the Apple story. We'll leave US tech there for one moment, but think more broadly about the earnings picture. What have we learnt this time around about the US consumer, about the global consumer? MasterCard was out with results yesterday. The credit card company reported profit that beat analyst estimates. The CEO saying, quote, "These results reflect healthy consumer spending and ongoing solid demand for their services and solutions." So that's the view of MasterCard. Let's get another perspective on where the consumer globally is going. Let's dive deeper into the European consumer story with Sarah Simon, Head of European Consumer Staples Research at Morgan Stanley. Sarah, very nice to speak to you. Put the focus on the European consumer for us at this point, because I feel we talk a lot about the Chinese consumer and how they're not spending as much as people had wanted them to, perhaps, or had expected them to, and a lot about US consumer because of the size of that economy. But what is the European narrative right now?
I think it was a bit of an understatement on the Chinese consumer. Definitely not seeing them spending. In terms of Europe, I think our sense is that they're still pretty cautious. The consumer has got more money in their pocket. If you think about disposable income, some of the income trackers are showing you that that's actually up. But I think still caution. What we're hearing is that essentially inflation has come down. That doesn't mean that prices have come down, and consumers are still finding those prices to be extremely high. And so in many cases, we are seeing trade down. We're seeing better performance in private label. Some of the more discretionary categories are doing less well. So I think still European consumer a bit of tempered with caution, even though you would think that the better wage growth ought to be actually giving people more money to spend.
OK, yeah, that's interesting, the way that real wages are playing out, higher real wages are playing out or not across Europe. Sarah, but yeah, let's talk about the Chinese consumer and the role it plays for European companies then. I mean, just one example, and I know we'll talk about the overall theme rather than the company, but one example of this, just yesterday, Estée Lauder, or earlier this week, Estée Lauder, having made big bets on China, that not playing out in very well for that particular business. But here in Europe, you see plenty of luxury names coming up against headwinds when it comes to China. Talk to us about the weaknesses of the Chinese consumer and whether you see anything turning.
So, I mean, obviously, luxury is a sort of extreme example, but we're also seeing in more low-end areas like beer that demand is soft because consumers in China are going out less. So you're seeing the on-trade perform less well, for example, than the off-trade. So it's pretty broad-based. Is there any sign of improvement? At the moment, we don't see it. Our teams in China say they don't see it. They believe that essentially the stimulus that's been applied so far ought to be positive for kind of, let's say, lower end, more basic spending rather than the high end. So we think probably more stimulus required to see really major change. But obviously the impact on the corporates is really varied because some have a much greater exposure to China. And then obviously it depends within the exposure whether they're more sort of high end or low end.
Sarah, what kind of pricing power do European kind of consumer companies have right now? And I ask this in the context of the fact that over in the States, a lot of the same category companies, Target is one example, are starting to look at price cuts. Are you seeing the same dynamic here in Europe?
We're not seeing price cuts that much. What we are seeing is a greater level of promotional activity. We see it particularly in the spirit sector, for example. So absolute price cuts, no. What we think is really going to determine pricing power is innovation and superiority. So those companies that are bringing new products to market that are demonstrably better than what's on the shelf, we think have a better chance in terms of price increase. But otherwise, price is kind of low single digits, but with quite a high degree of promo going on in the background.
So that's the demand side of the equation. Anna already spoke to you about China, but I'm curious about the United States and how perhaps tariffs, you mentioned spirits as well, could change the dynamic, again, in terms of some of the margins or even some of the supply chain that goes into it. How are you thinking about the impact of the U.S. election?
I mean, you know, we're talking, in my respect, about consumer staples. So people have to eat and drink and wash and clean their houses on a fairly consistent basis. But certainly the stocks you would choose to invest in will be partly contingent on your view about whether they're more economically sensitive or not. So what we're seeing at the moment is people trying to play companies which are more so let's say economically sensitive and more exposed to the US in the hope of some kind of a pickup post the election as people put away the kind of nervousness that they're feeling ahead of the election and get back to spending.
Certainly an exciting couple of days ahead of us, 4 days away from the U.S. election. Sarah Simon, head of European Consumer Staples Research over at Morgan Stanley, joining us this morning. And let's take a little bit of a zoom out, if we can, and go right back to the bond market. Gilts continue to slide. Traders betting on a BOE cut inching lower. Let's bring in Bloomberg's Valerie Teitel, who is, of course, watching this with, I feel like popcorn somewhere.
Look, Kriti, I think there's a real nervousness now in the gilt market because if we don't find a firm footing, if we don't shake off this volatility, we are headed into one of the biggest week of risk events with the U.S. election, with the massive risk out there that we could see a big repricing in Treasury yields higher. And that could force this gilt market to deal with yet another disruption going on, across the pond in the U.S. with a Treasury market jolt. And if we don't find another firm footing in the gilt market, not only do we have the election, on Thursday we get the Bank of England, and we're due to get their inflation report. It's their time where they give us their forecasts for growth and inflation. That could also jolt the market forward. So there really is not a lot of time, Anna, for the gilt market to calm down, and it doesn't look like we're getting it in today's session.
Yes. bond vigilantes, perhaps paying attention to what's happening here in the UK quite keenly. We spoke to Pooja Kumra earlier on from TD Bank, and she was talking about the move being mostly at the short end. The moves are smaller today, but they're across the curve, and that seemed to be something that worried her when this starts to show up along there, especially thinking about US election risk and what might happen to Treasury yields next week.
Yeah, that's a good point. We have not seen this move in the gilt market being led by the long end, and perhaps that's the one bit of the bright shine of this move that we have seen in the gilt market. Now, on a Trump win and a big repricing in U.S. Treasury yields higher, most do expect that to be led by a steeper curve and to be led by the long end. So, again, it's all down to this U.S. election outcome. Perhaps we could see a long end gilt sell-off after a Trump win, let's say, on Wednesday morning. And then if we go right into a Bank of England who is telling us that their growth forecasts are higher and their inflation forecasts are higher, that is going to be a double whammy for the gilt market to digest.
All right, Valerie Teitel, we're not ready to let you go just yet because we've got our eye on some more fun things, I think, perhaps outside of the gilt market as well. We've got payrolls as well that we're going to be digesting. So that's going to be an interesting thing in the next 24 hours.
Yes, I feel this next pivot is difficult. But if everyone needs some welcome relief at the weekend, we now have a rundown of things to look ahead to over your weekend. Maybe jazz is what everybody needs. It feels that way here in London, watching the gilt markets. We'll see where we end up today, and then we'll all hot-foot it to Rome for the Jazz Festival. There's also a visual arts festival taking place in Ireland, if that's your thing. There's plenty of sport to watch. England versus New Zealand in a rugby match. Apparently, so our New Zealand producer tells us that's important. Sao Paulo Formula One Grand Prix, all of that. Well, there's plenty of distraction if you want to get away from the economic agenda.
But I feel like this is where Valerie's time to shine. Are you into the rugby?
Oh, well, I do live in southwest London, and that does tend to relate itself to Twickenham also being in southwest London. It's always very busy around my area in the pubs when they are playing.
But you have lots of work to do before we get there, because if we cast our eye across what's happening today, we get, of course, a US jobs report, Valerie, and we need to pay attention to all of the one-off effects in there before we get to the weekend.
The jobs report is an hour earlier than normal, so the weekend does start a bit earlier, Anna. Maybe we can get some extra rest before the election next week.
Yeah, certainly something to keep an eye on. Valerie Teitel, we thank you so much, of course, bringing us a breakdown of all things in the bond market as well. 136,000 is the whisper number. She was talking about the payrolls report. But I think it's interesting that the gilt market ultimately, even though it is reacting to the budget, may actually be volatile in a different direction in just a handful of days.
Yeah, we'll certainly keep an eye on there's a whole lot of complicated transatlantic dynamics going on here, aren't there? Because the UK is undisputedly moving because of its own dynamics around the budget, around the OBR's assessment, about inflation and what the Bank of England does from here. But very quickly we get caught up in that US trade, don't we, when we've got the jobs report later on today and, of course, the US election next week. A reminder that over the weekend, Bloomberg is helping you keep track of news flow over the weekend. Be sure to catch Bloomberg's new weekend edition, bringing you a collection of ideas, essays, reviews, interviews and stories that explore that place where finance, life and culture meet. And perhaps after such a busy week and ahead of a really busy week next week, perhaps that's what we all need. The Bloomberg Weekend Edition available on the QR code on your screen. That is it for the opening trade. Have a good weekend, everybody. This is Bloomberg.